In 2025, gold did the one thing the crypto world swore was impossible. It beat Bitcoin. But if you think this is just another story about digital assets failing, you're missing the real, much bigger picture. What happened wasn't about one asset winning and the other losing. It was a giant warning sign for the global economy and a critical signal about where we are in this market cycle. In the next few minutes, I'm going to show you what this signal means, why it happened, and how the smartest investors on the planet are using it to prepare for what's coming. This isn't a victory lap for gold bugs or an obituary for Bitcoin. This is a deep dive into the machinery of the global financial system, and it affects every single one of us. All right, let's get right to it. For years, the narrative was simple. Bitcoin is the new digital gold, an unstoppable force that was destined to replace the old world relic. But 2025 turned that story completely upside down. Gold didn't just outperform Bitcoin, it became one of the strongest major assets in the world, while Bitcoin, despite hitting a new all-time high, ended the year with gut-wrenching volatility that shook out even the most seasoned traders. Gold posted incredible year-to-date gains, with some reports showing a surge of over 60 to 70%. Bitcoin, on the other hand, experienced a brutal 30% correction from its October high, wiping out nearly $600 billion in market value from its peak in just a few weeks. So what gives? Why did the old money asset suddenly run circles around the future of finance? The easy answer you'll hear everywhere is that Bitcoin is volatile, a risk-on asset, and the market got spooked. That's true, but it's only half the story, and the other half is what really matters. The real story is far more complex, and it reveals a powerful truth about how money, debt, and power actually work. This wasn't a fluke, it was a forecast. For the better part of a decade, the conversation was framed like a cage match. Gold versus Bitcoin. The boomer rock versus the digital revolution. The argument was that as the world became more digital and decentralized, Bitcoin would inevitably siphon capital away from gold's multi-trillion-dollar market. And for a while, that seemed to be happening. Bitcoin's returns were astronomical, making gold's steady single-digit annual gains look boring. The common explanation for 2025 is that when recession fears hit, investors fled from risky assets like Bitcoin back to the safety of gold. It's a simple, tidy explanation, and it's wrong. It misses the most important part of the equation. The real story of 2025 isn't about risk on versus risk off. It's about a fundamental shift in what the market is hedging against. For years, the main bet for assets like Bitcoin was currency debasement. The idea was simple. Central banks will print trillions, devaluing fiat currency, and a scarce asset like Bitcoin with its fixed supply will be the ultimate life raft. That's the debasement hedge. Gold, however, serves a different, more ancient purpose. It isn't just a hedge against the quantity of money being printed. It's a hedge against the quality and credibility of the institutions managing that money. It's a bet against policy mistakes, geopolitical instability, and a breakdown in the trust that holds the entire financial system together. In 2025, the market's main fear shifted from simple currency debasement to a much deeper concern: a loss of faith in the system itself. And when that happens, the market doesn't just want a new technology. It wants an asset with no counterparty risk, a 5,000-year history, and one that sits in the vaults of the very central banks whose credibility is being questioned. Gold didn't beat Bitcoin because Bitcoin broke. It won because the macro game changed from a bet on tech disruption to a desperate search for stability. Let's look at the numbers, because they don't lie. First, performance. Gold began the year strong and just kept climbing, breaking through $4,000 an ounce and hitting an all-time high of over $4,500 in December. This led to year-to-date gains that approached 70% at its peak, marking one of its best annual performances in decades. Now, look at Bitcoin. It had a wild ride. It started 2025 around $93,000, dipped, and then screamed to a new all-time high of over $126,000 in October. But from that peak, it was a bloodbath. The price collapsed by over 30%, ending the year struggling to hold the $88,000 level. So, while it still ended the year without a major loss, its behavior was that of a high beta tech stock, not a safe haven asset. This divergence is perfectly captured by the most important chart in this debate, the Bitcoin to gold ratio. This tells you how many ounces of gold it takes to buy one Bitcoin. At the end of 2024, you needed about 40 ounces of gold to buy one Bitcoin. By the end of 2025, that number had been cut in half, dropping to around 20. This 50% drop is a stunning visual of gold's relative dominance all year. So, what drove this? Let's peel back the layers. Driver number one was the central banks. These are the ultimate smart money. In 2025, they continued their massive buying spree. While the pace was slightly slower than previous record-breaking years, net purchases still tallied hundreds of tons, with countries like Poland, China, and Turkey as major buyers. This wasn't just trading, it was a long-term strategic shift to de-dollarize their reserves and hedge against the very instability they are part of. They weren't buying Bitcoin for their reserves, they were buying physical gold. Driver number two was institutional ETF flows. Here, the story is fascinating. Gold-backed ETFs, after seeing outflows in previous years, saw a massive reversal, with holdings increasing by nearly 400 tons in the first half of the year alone. This was a clear signal that large asset managers were building defensive positions. Meanwhile, Bitcoin ETFs told a story of waning momentum. While total assets under management remained high, they saw significant outflows in the latter half of the year, falling from a peak of over $150 billion. The hot money that poured in was just as quick to pour out when the macro environment soured. The final, crucial driver was the macroeconomic backdrop. 2025 was the year the market started looking ahead, anticipating that the Federal Reserve would be forced to cut rates to manage the enormous government debt, even if inflation remained sticky. Falling real yields reduced the opportunity cost of holding a non-yielding asset like gold, making it more attractive. Critically, these same forces didn't help Bitcoin, which traded more like a tech stock, sensitive to stock market sentiment and liquidity. The low correlation between the two assets confirms they were marching to the beat of different drums. When you put it all together, central banks hedging systemic risk, institutional money seeking a true safe haven, and a macro environment that favored monetary assets over purely speculative ones, gold's outperformance wasn't a surprise. It was an inevitability. So what's the big flashing signal the market sent us in 2025? It's this. We are in a late cycle environment defined by fragile policies and a flight to quality. This isn't just a temporary dip, it's a regime change. Think of it like this. In the early and mid parts of a market cycle, when growth is strong and money is cheap, investors get rewarded for taking risks. They chase high-growth tech stocks, venture capital, and yes, Bitcoin. The main goal is wealth creation. But in the late stage of a cycle, the game changes. Growth slows, debt becomes a problem, and the risk of a policy mistake, like cutting rates too late or raising them too high, is huge. At this point, the goal for smart money shifts from wealth creation to wealth preservation. Gold's surge in 2025 is a classic late cycle signal. Its strength, even when headline GDP numbers looked positive, showed that professional investors were reading between the lines and looking at the cracks in the system. They see the dissent within the Federal Reserve, the global tensions, and the structural weaknesses. They are buying gold not just as a bet that it will go up, but as insurance in case other things go very, very wrong. Gold is acting as a hedge on monetary credibility itself. Bitcoin, on the other hand, behaved exactly like a late cycle risk asset. It soared when the promise of more liquidity was high and got crushed when that liquidity tightened. Its 30% correction wasn't a failure of its long-term thesis. It was the predictable result of an asset that is highly sensitive to market liquidity and risk appetite. This doesn't make Bitcoin a bad asset, it just clarifies its role. It is not, as of today, a direct competitor to gold as a primary reserve asset. It's a high-powered, high-volatility bet on future currency debasement and technological adoption. It's a piece of a growth portfolio, not the foundation of a preservation portfolio. The smart money gets this distinction. They aren't selling all their Bitcoin to buy gold. They are recognizing the different jobs these assets do. Fund manager Lawrence Leopard has long argued for holding both, seeing them as complementary bets against a failing fiat system. The win for gold in 2025 doesn't invalidate Bitcoin. It just tells you where we are in the cycle. It's a message that the financial weather is changing, and it's time to check your portfolio's foundations. This brings us to the most important question. What happens now? If gold's victory was a signal, what is it signaling for 2026 and beyond? History gives us a fascinating roadmap. There is a clear sequence to how gold and riskier assets behave around major market turning points. Gold almost always moves first. Look back at previous cycles. In the run-up to the 2008 crisis, gold started to climb while stocks were still falling. It provided the stable base before the massive liquidity injections that followed sent risk assets soaring. We saw a similar pattern in 2020. Gold rallied first as the pandemic hit, acting as the initial safe haven. Bitcoin followed, but it moved later and much harder once the central bank printing presses went into overdrive. The performance in 2025 isn't the end of the story. It's the beginning of the next chapter. Gold's outperformance is the first phase, the institutional flight to safety and the hedging of systemic risk. It's the market bracing for impact. The next phase will likely be driven by central banks. The very rate cuts that the gold market is anticipating are what could eventually refuel the bull market in risk assets. When central banks pivot from fighting inflation to stimulating growth, that new wave of liquidity has to go somewhere. And historically, that's when assets like Bitcoin and even silver tend to explode higher. So, the key takeaway isn't to choose between gold and Bitcoin, but to understand their sequencing. Gold's current strength is the market's way of telling you to build a defensive foundation. A common allocation strategy might involve a 10 to 15% holding in gold for stability, complemented by a smaller 1 to 5% allocation to Bitcoin for its explosive upside potential. The fall in the Bitcoin to gold ratio from 40 to 20 should be seen as an opportunity signal. It means that, relative to gold, Bitcoin has gotten cheaper. For investors who believe in the long-term story, this period of underperformance is the time to be accumulating, not panicking. The smart money isn't thinking gold versus Bitcoin. They are thinking gold now, Bitcoin later. So let's bring it all home. Gold beat Bitcoin in 2025. But this was never a story about Bitcoin's failure. It was a story about gold's enduring function as the ultimate barometer of fear and distrust in our financial system. Its surge to over $4,500 an ounce was a vote of no confidence in the ability of policymakers to handle the mountain of debt and geopolitical tension they've created. Bitcoin's volatile year, with its spectacular rally to $126,000, followed by a painful 30% crash, perfectly confirmed its role as a high-octane risk asset, a passenger on the global liquidity train, not the engine. The divergence between these two assets is the single most important lesson of 2025. It's a clear signal that we've entered a new phase of the market, one that demands a more sophisticated approach than just being all in on one thing. It's a call to understand the unique roles different assets play. Gold is your shield. It's the foundation of wealth preservation in an uncertain world. Bitcoin is your sword. It's the asymmetric bet on the future of finance, an asset that thrives on the very liquidity that crises eventually force into existence. The mainstream narrative will try to pit them against each other, but the real story, the one the data is telling us, is that they are two different tools for two different jobs. Understanding that difference is what will separate the novice speculators from the savvy investors in the years to come. What happened in 2025 wasn't the end of the debate. It was the beginning of true understanding. The financial markets are sending us signals like this every single day. But most people are too busy listening to the noise to see them. If you want to stay ahead of these massive market shifts and understand the deeper economic forces at play, make sure to subscribe and turn on notifications. We break down these complex topics every single week to give you the clarity you need to navigate what's coming. Don't miss the next signal. And this geopolitical fracture explains something most people still don't understand. Why gold didn't just outperform stocks in 2025, it outperformed Bitcoin. In the next video, we'll break down why that happened and what it signals about where we are in the cycle.